All right, so when we get started, quick introduction. My name is Mark Lamonic. I'm the product manager for Morningstar Premium at morningstar.com.au. Today, we're going to talk about how to value a share, which is what we were going to talk about the other day until I screwed that up. So apologies for anyone who happened to stay till the end of last session. Not my finest moment, but anyway, we'll see if we can do better today. So first, disclaimer, housekeeping item. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand and you want to see our FAP, you can go to morningstar.com.au. It is on our website. And in New Zealand, the regulatory authorities would like you to reach out to a financial advisor if you would like any personal advice. Also, would love questions. We had a very early question in the session on Thursday. It wasn't so much a question as a statement, you are doing the wrong topic. Yeah. That hopefully will, let me see what's happening. Somebody said they have a blank screen. How about that? Did that help anyone? I don't know. Hopefully, so add another comment or put something into the chat if you're having issues seeing the screen. Okay, why don't we get started? We're gonna try to do a better job than Thursday, but anything can happen. So hopefully people can see the slide deck. Once again, let me know if you can't. We're going to talk about how to value shares. So for anyone who started at the beginning on the Thursday session, we did go through a little bit of this, but I'll do it quickly again. So we've got this long quote. It's Warren Buffett. We're going to talk about what it takes to go out there and value a share. We're going to start with a great company. So philosophy we have here, Morningstar, and a common philosophy with investing is that you want to buy a great company at a compelling price. So that's what we're going to talk about today. So let's start quickly with what a great company is. And here's this quote by Warren Buffett. And he's really just talking about a great company is a company that has a moat. So moat is probably a term you've heard a lot if you read a lot about investing. And a moat simply means a sustainable competitive advantage. We'll talk about what that means. And obviously this came from the Middle Ages. You'd have a castle, you'd build a moat around it. That protects the castle. A sustainable competitive advantage, of course, protects a company from competition. Now, competition is, of course, what we're trying to foster in capitalism. It's supposed to benefit us as consumers. So companies will compete by building better products. Companies will compete on price. And as consumers, we are supposed to be the beneficiaries of all this competition. Now, we put on our investing hats and we look at companies, all this competition isn't so great because, of course, other competitors coming out with similar products is going to make it harder for us to maintain market share. Other companies coming in and trying to undercut on us on prices, it's going to force us to lower our prices. And what that means is our margin will reduce. So our margin, the difference between what we sell something for and what we actually make in profit as a company. So that will reduce from competition. So we're looking for companies that have certain attributes about them that hold off this competition. And over the long run, we believe that any company that does not have a moat, what will basically happen is the return they get on the investments on the company will eventually come down to the cost of capital. So let me try to explain that, just what that means. It basically means that a company is obviously an entity. There's a lot of momentum and a lot of reasons a company wants to continue, namely that a bunch of people work there. They obviously are continuing to try to do better, any company. But if you do not have a competitive advantage, basically, you will keep investing money in that company at a return that meets your cost of capital, meaning that if you can go out and borrow money for 7%, you're probably ultimately going to go and invest that for a 7% return. Now, you may not say that you're going to do that, but eventually you will see those two things intersect. Now, a company that has a moat is a company that's able to go out, source capital, get funds to invest in the business, and then earn a return on those funds that are beyond that cost of capital. And that's what we want as investors. So let's talk a little bit about moats. So at Morningstar, we have 5 different sources of moats, basically meaning what we do is we take companies that we believe have a moat and we categorize them in these 5 different categories. So let's talk through these categories and then why these attributes of a company can help you sustain this competitive advantage. So we'll start with intangible assets. So intangible assets, think about a balance sheet. For those of you that understand accounting, a balance sheet is simply a snapshot of a company's assets and their liabilities. So assets can take different forms. You can have a tangible asset. So a tangible asset is something you can see, go and see. So real thing. So a tangible asset could be a factory, for example, that you invest a bunch of money, you build a factory that has a tangible asset. Now sit on your balance sheet because it's something that the company is using to make money. They're going to manufacture goods in that, they're going to sell that. Your Quantis, a tangible asset is an airplane. So you go out and you spend a bunch of money on an airplane, and right now, most of them just sit there somewhere. But in theory, you can fly around and people pay you to take them to different places. So that is an asset of a company. Now, an intangible asset is an asset of a company that's not on the balance sheet. So it's not something that we can go out there and see. And you can see some of the examples. A brand is an intangible asset. There's no accounting treatment and no way for us to value the brand of Coca-Cola that's been built up over a century, but it's still an asset, still something that's very, very important to the well-being of Coke. A patent. So if you invent something and only you can produce that and sell that, that is an intangible asset, as is a government license. Same thing, the government license is telling you that only you can operate a certain business somewhere. Those are all intangible assets, and those can be sources of moats. So the example we have here is Coca-Cola, but we can also use for patents, government licenses. We can look at, pharmaceutical companies are a big one. They may have the ability just to have a monopoly on a certain drug for a while after they invented it. But let's use Coca-Cola as an example. They built this brand. What that means is almost no matter where you are in the world, back when we could go, leave the country, you could go and walk into a store and you'd see a Coke, and you know what that Coke is. You probably assume a certain level of quality. You know what it's going to taste like. And that brand, of course, means that you're more likely to turn and buy that Coke because you know exactly what it is. So that's an example of brand. And that brand keeps competitors at bay because I can't go create a soft drink company out of scratch that has a brand that compete with Coca-Cola. So that's a real competitive advantage of theirs. Next thing is cost advantage. So we talked about one of the hallmarks of having a moat and a sustainable competitive advantage is margin, that you're able to charge more, you're able to make more, even if you charge the same amount. So cost advantage is really, really important. So what we're talking about is economies of scale here. And we've certainly seen that in a lot of different companies. We'll use Amazon as the example here. Amazon, particularly in the US, is able to sell goods for a lot cheaper than almost anyone else because of the scale they built, because of the infrastructure they built, the warehouses, everything else. They're able to sell things for cheaper. Now, they have decided as a company that rather than make more money on the products that they sell, they've decided to undercut their competitors and expand. Now, that's a decision that they've made. And in the long run, obviously, that's going to allow them to expand market share and so grow their revenues. And they still probably make the same margin as a lot of their competitors, either by selling stuff cheaper because they have a cost advantage. The next one is switching costs. So obviously, we talked about capitalism. If you have a product or a service, somebody else can come along and most of the time just copy that. Now, switching costs refers to the fact as a consumer, if you don't want to switch. And the perfect example, and what we always talk about with switching costs, are banks. And people simply don't want to switch because it's a pain. And the banks obviously know that. And so what they do is all of a sudden they get, quote unquote, more and more tentacles on you. And they sit there and and you set up all of your friends on your bank account so you can easily send them money. You have automatic bill pay. You might have lots of different products. You might have a credit card and a mortgage and a transaction account and a brokerage account. And so at the end of the day, you don't want to switch. You have your salary going directly in there through direct deposit. It's a big pain for you to switch and go out there and set all that stuff up again. So people don't do it. And so even if competitors come along and they offer a slightly better product or banking terms, a slightly better rate, you may not take it because you don't want to go through that trouble of actually switching that. So that's switching costs. And we have CBA, of course, as an example. Network effect. I'm trying to go through this stuff quickly so we can get into the valuing of a share part of things. So network effect, we always talk about social media. So basically network effect means the value of something increases the more people use it. And social media is always a good one to talk about because it's an easy example to use that most people understand. So whether you like Facebook or don't like Facebook, Facebook is less fun if you're the only person on there, right? So if you're going on there to try to share things with friends and family, photos, and none of them are on there, it has little value to you. But once you get enough people on there, obviously the value increases. So that's a good example of network effects. So it'd be very difficult to come on and displace something that has a huge network. And then last is efficient scale. And efficient scale is probably the one that people are most confused about. But what it basically means is that you are serving a very limited market. And this very limited and specific market, you could have a near monopoly in this tiny market, and nobody really wants to come in and compete with you because it's not worth it. So at the end of the day, they just don't want to come in and invest a bunch of money to try to compete with you when the market's very, very small and the rewards aren't that big. So a big one on here, we'll talk about enterprise product partners, but this is also a good example that a lot of pharmaceutical companies have, that if you are, of course, curing a disease that a lot of people have, fine, people are going to go in and compete about that because the pool's big enough to make money. But if there is some obscure disease that very few people get, you can make a very specialized drug for that. You can charge a lot for that, so a lot higher margins on it, because other pharmaceutical companies are not going to come in and invest to try to capture that small pool of patients. And enterprise product partners is a pipeline company. And for things like pipelines, a pipeline company in the US and Canada, same thing. You build a pipeline moving natural gas from one place to another place. Nobody's going to build a pipeline next to you at the end of the day, just because there's a limited amount of natural gas that you want to move between these two different spots, and it doesn't make sense to build another pipeline. So that's another example of efficient scale. All right, so that was our very quick overview of moats. So talking about a great company. Now, how do you analyze a moat? Well, our analysts, of course, do it. So they categorize all the companies they cover into 3 different categories. So wide moats. Those are companies that they believe the sustainable competitive advantage will last for at least 20 years. We have narrow moats. So that's when they believe it will last for 10 years. And then most companies we cover, as I said before, have no moat. We do not believe that the company has a sustainable competitive advantage. So what can you do as an investor? Well, of course, it's understanding the company. And this is really, something that we stress a lot at Morningstar is fundamental research. No matter what, you need to understand the business that the company's in. And I think Warren Buffett's a perfect example of this, that, he is a student of business. So more so than investing, and you'll understand when we sort of get into the technical side of valuing something, he is a student of business, because a lot of times the calls that people make on these companies, like he made when he bought Coca-Cola a very long time ago, was that he believed the market was undervaluing something, and that something was an intangible asset. It can't be measured on a balance sheet. You can't go examine something that is, say, intuition is probably the wrong word, but that's sort of the art side of investing. So this is really just understanding a company, understanding the dynamic that they operate in. And if I can give a pitch for our analysts, one of the things that I really like about our analyst report is they will explain why they think a company has a moat or why they don't have a moat, and they'll explain the business environment that the company is operating in. And whether you agree with them or not is kind of besides the point. They will frame an argument, and I think it's really helpful for me to read their argument, and even if I disagree with them, to at least understand that and have that be a jumping off point for me to start thinking about a company and start thinking about the business they're operating in. All right, so we're going to spend the majority of time today on valuing a company. So I wanted to start with this quote from Phil Fisher. So Phil Fisher wrote Common Stocks, Uncommon Profits, another kind of classic investing book. And he was an investor on the West Coast in the US, and he was a growth investor. So we talk a lot about, obviously, different types of investors, value investors and growth investors. He is a growth investor, but I do love this. I love this quote, and we'll talk a little bit about, I think there's some misnomers. We'll talk later about sort of value investors and growth investors. Well, let's do it now. Both of them are very focused with valuation. Some of them, and when we get into the spreadsheet and go through the model, are very focused on, okay, how much do I want to pay for the growth that's happening in this company? Where generally value investors are focused much more on the, what does the company have right now? What's the earning power they have right now, rather than the future. But in both cases, you're trying to value the company. Now, you may be valuing different things, but you're still valuing the company. So that's why I really like this quote, that stock market is filled with individuals who know the price of everything but the value of nothing. And really the concept behind this is that it's easy for us to find the price. We can go onto morningstar.com.au or just Google a share price, and we can find the price of everything. And we are bombarded with price. Every day the price changes. Obviously, throughout the day, throughout the trading day, the price changes. So all we see is price. But as investors, we need to be focusing on value because we are valuing the business. Yeah, so Michael's saying the Phil Fisher quote is attributed to Oscar Wilde. Yes, so he had a very, very similar quote. So that is that's good. Thank you, Michael. All right, so let's talk about how we value a share. Now, where does the value come from? So the value could be book value, and I'll explain what these are, earnings, cash flow, but what are we actually valuing when we're valuing a company? One very important thing to remember is we are valuing the future. So at any point that you buy a share, or at any point that you own a share, you are owning that share for the future. What happens in the future? Now, the problem with investing, of course, is all of the facts you have, and I'm paraphrasing another quote here by Bill Miller, who is a portfolio manager at Legg Mason. He has this quote that says, yeah, everything that you are buying for a company, basically I'm paraphrasing, is occurring in the future. All of the information you have is in the past. So remember, when you start looking at anything with a company, any ratio about a company, the financial statements all are historic, and we don't care about them except for that they can offer clues into what the future might hold. So it's an important thing to remember. All right, so what are some of these terms? What are we actually valuing? So book value. Book value means we're basically valuing the balance sheet. So when you hear book value, and there's a couple nuances to it, but for the purposes of this, book value is essentially the assets minus the liabilities. So back in my example where a company has a factory, it is saying, okay, how much is that factory worth? How much could I sell that factory for? And this is sort of the classic value investing approach. So this is how Ben Graham did things. So Ben Graham, of course, wrote The Intelligent Investor, security analysis, and kind of professionalized investing. Now, he was this deep value investor, but he was also investing back before and then after the Great Depression. So huge stock market crash, things were really, really cheap. And when he would go in there and he would concentrate just on book value, he didn't care about the business. He would just sit there and look at the balance sheet and say, okay, and because in this day you could do that, I can go buy companies that I could actually sell off and they would be worth more than what the share price is. So it was that famous line in Wall Street, I don't know about the line, but the original Wall Street, where they're talking about buying the airline and selling off the gates and the routes and taking money out of the pension plan. That is a Ben Graham investment approach, right? That I'm going to go buy something that literally is worth, and in many cases had more cash on the balance sheet minus liabilities than what you were paying in a share price. Now, it was easy to invest that way. I don't know about easy, but it was possible to invest that way after the Great Depression, during the Great Depression. It's not possible anymore. So we don't pay as much attention to book value anymore. Book value now is just kind of a multiple that we're looking at because you're paying many, many times what's on the balance sheet. The other thing that's really important about book value is the economy has changed and successful companies have changed. So back in Ben Graham's day, when he's sitting there looking at a company in the 30s, and if you read The Intelligent Investor and you read security analysis, this is what it's concentrating on. Companies were different. How did you build a company? Most of the stuff is manufacturing. So for me to have a company, I had to build a bunch of factories. I had a bunch of assets. I had a very asset heavy company. And there's still some that exist now, but especially with technology companies, now we're moving away from tangible assets to these intangible assets, right? So if you were to sell off Google, what would you sell off? Well, there's not much, right? A lot of their talent is, or a lot of their earnings power comes off of the talent of the employees they have, things that you can't necessarily sell. And that's how you make money. So investing has changed because valuations are much higher, but also just business has changed. That's book value. Earnings. So earnings, of course, what a company makes. We'll talk a little bit about earnings in a second, but looking at revenue, how much of that are they actually keeping? So earnings are really important. These are all future earnings, of course. Cash flow. We're going to get into some of the differences. What is the difference between earnings and cash flow? And we'll get into that when we actually go into the spreadsheet, but they're different. Cash flow represents literally cash in, cash out. So most of us obviously probably manage our personal finances on a cash flow basis. And you log into your bank account, you got paid, some money went out because you spent it on, I don't know what you can spend money on now in Sydney, but something. So cash comes in and cash goes out, sort of how we manage our lives. Earnings are very different because they're based on accounting. So we'll get into that in a second. But remember, everything that we're valuing about a company occurs in the future. All right, so what are we going to do today? We are going to walk through, it's going to be fun with Excel. We're going to walk through a discounted cash flow model or DCF model. And so this is basically the description. So we're going to do a couple things here. We're going to rely on cash flow. So you should get that in the name, discounted cash flow. We're not going to look at earnings. We're going to look at cash flow. We, of course, are looking only at the future. Now, the future, of course, is unknowable. So we have to forecast. We have to predict what we think is going to happen in the future. Then the discounted, the D and the DCF, is we need to discount that back to the present day. So this is what the exercise we're going to walk through today. Now, a discounted cash flow model is essentially how everyone values companies, everyone in terms of professionals. So even if you're not going to do this yourself, it's important to understand these different principles because then you'll understand the different inputs that go into this. All right, so now I'm going to try to find this spreadsheet. I, of course, have 900 windows open, so it takes me a while. So sorry for that. I showed up a little late and did not get to close everything. Where is this thing? All right, here we go. I found it. All right, so we're switching to our good friend Excel here. All right, so we're going to walk through a couple different things. And I say this every time, and I've changed this a little bit actually since I did this last. So if anyone wants this spreadsheet, send me an email at mark.lamonica1@morningstar.com and I'll send it to you. All right, so I want to focus this section under a year first. All right, so let's talk about a couple different things that we hear a lot when we hear about companies and what it means and how it sort of goes into the model. Now, this is very simplified, but I'll sort of get into what other people do. All right, so what are some of the things that we want to focus on? We want to focus on top line or revenue growth. So you'll hear top line a lot. So when people say top line and they say bottom line, they're literally referring to an income statement. The first thing on an income statement is revenue, it's sales. The last thing on there is income. So that's top line, bottom line. So people use those, would use those different terminology. All right, so what is top line growth? It's simple, it's sales. So remember, we're talking about businesses here. It should be pretty simple. I run a corner store. I sell $400 worth of stuff on Monday. That is my top line, sales, $400. All right, so what we need to do if we're creating a DCF model, if we are forecasting into the future, we have to start by saying, okay, how much do we think that this company is going to sell? Now, there's all sorts of different things that we can look into that we can do to look at this. Number one, of course, we can look historically and we can say, okay, well, what has been their growth rate in revenue historically? And that can be a starting off point, but we need to figure out like what were the factors that contributed to that, and will this continue into the future? So this is why we need to understand the business and understand what they're actually doing. So we estimate that into the future. Next thing we need to look at is how do we translate those sales into what we want, which is basically cash flow and earnings. So that's the next step we have to take. So let's talk about EBIT. So EBIT is earnings before interest and taxes. So EBIT is a term that you will probably hear a lot. You'll probably hear a lot about an EBIT margin. So we're looking at EBIT margin here. So basically that means what percentage of sales do we get down to this earnings before interest and taxes? Now, EBIT is kind of an approximation in some ways to parts of cash flow, but we'll get into some specifics. So I'm looking at the margin. What do we get before earnings before interest and taxes? All right. What are other things we need to take away? We need to look at, and this is where we're looking at the difference between earnings and cash flows. Remember, so accounting-based earnings and cash flow. So one of the big things that's included in earnings is we take away non-cash charges. Let's talk about these for a second. And this is getting a little too nerdy, just let me know. So what do we take away? We take away depreciation and amortization. Let's walk through what both of these mean. Remember when we talked about that Qantas example, that a company has an asset. Qantas, one of their assets are airplanes. They spend a lot on those airplanes and they use them to make money. Now, an airplane, of course, has a useful life. So an airplane can't fly forever. So when Qantas buys an airplane, they know that the airplane can only last so long. So whether they're measuring that in years or hours of flight, whatever they're measuring in, they know that there's only a certain amount of time that airplane can last. So because that is an asset on our balance sheet, we can't just have it sit there. If they spent $100 million on a plane 10 years ago, we can't have $100 million sit there because the plane's not worth $100 anymore. We're trying to look at assets. So what do? We depreciate that asset over its useful life. So the simple example is if Qantas paid $100 million to the airplane, it's going to last 10 years. So what do? Every single year, we take $10 million off of that airplane so that the asset is $100 million, then it's $90 million. We keep marching it down. So at the end, when Qantas has to junk this plane or hopefully sell it for something, we'll take that into account, we depreciate the whole asset off the balance sheet. Now, because it's an accounting rule, and I know that this is not the world's most exciting stuff, because that's an accounting rule, we need to take that depreciation, it needs to go somewhere. And where does it go? It gets taken away from earnings. So every year, Qantas owned one plane. Every single year, we would take $10 million away from earnings. That would be a non-cash charge. So you understand the difference, right? Because a non-cash charge is something that Qantas doesn't have to pay anything for. They've already paid for the airplane. The cash already went out the door. They already paid $100 million for it. They're now taking that $10 million charge every single year and it takes it off of earnings. So that is a hit to earnings, but it is not a hit to cash flow. So hopefully that makes sense. Now, conversely, they will capitalize that asset when they buy it, which basically means that they are not going to take $100 million off their earnings when they buy that airplane because they're going to capitalize it, then depreciate it over time. But from a cash flow perspective, they do pay $100 million. $100 million has to go out the door. So that is a non-cash charge. Amortization is also a non-cash charge. Amortization is basically used for intangible assets. So tangible assets like an airplane, intangible assets. And a lot of those, like we talked about how a lot of those aren't on the balance sheet. Some are. There's like goodwill and things like that when you buy a company that you're saying the company's worth more than you actually pay. We don't need to get into the technicalities around this. All we need to understand is that there are differences between cash going in and out the door and accounting statement earnings. And there's all sorts of differences, but this is stuff that we want to take account for. Working capital is pretty simple. So working capital, all that means is that we are looking at sort of current assets and current liabilities. How much like cash do you basically have to keep on hand? We don't need to go through the specifics of that. A capital expenditure. Okay, so what's a capital expenditure? Capital expenditure is when we are looking at an example, buying an airplane. So we have these big one-off potentially charges. There's often a lot of fluctuation around capital expenditure. So Qantas example, maybe 1 year they'll go buy a Dreamliner and 1 year they'll go buy some crappy little plane. And so it's lumpy. There's big differences in the cost. So when we want to calculate the free cash flow, we want to take EBIT and we want to subtract all of this stuff. We want to subtract depreciation and amortization. We want to subtract, because that's a non-cash charge. We want to look at these changes in working capital because you do need some cash to run the business. So we want to keep that separately. Capital expenditures, we want to take out because what we're really looking at here is operating cash flow. So from a day-to-day basis, what is the company generating in cash flow? And capital expenditures are different, right? Because they're not one-off. They occur, well, randomly is the wrong word, but they bounce around a lot. So we want to remove all that from free cash flow. Now, there are lots of different cash flows that people look at. This is just the one I'm looking at. So why are we not taking account of interest? So why do we have this EBIT thing? We'll get to that in a little bit, but we're not looking at interest because we're trying to figure out what is the cash flow that is generated for everybody who is everybody who has a say on the cash that's generated by this company. So that's bondholders, that's the interest charge, and it's equity holders. Now we'll make an adjustment at the end for that. So hopefully this is making sense somewhere. Okay, so let's talk about a couple other things that we need to do here. So that's the basis, right? We take top line growth, we look at how that gets translated into bottom line, and then we're looking at cash flow. How much cash do we actually generate as a company? That's what we're trying to do here. Now, because we're worried about the future, we have to do all of this into the future. So our analysts, for example, they estimate 10 years out. And what they'll do is they'll rebuild all the financial statement or build all the financial statements. So the balance sheet, the cash flow statement, the earnings, income statement, they will rebuild all of those for 10 years out. Now, this is obviously their job. If you're doing this at home, you're probably not going to do that. And that's where you can kind of use some different shortcuts to try to estimate this for you. So they're building that 10 years into the future. And we'll talk about what happens after 10 years. But we need to discount that back. So remember, we're using a discounted cash flow model. Now, the reason we discount is because of the theory, the time value of money theory, which is sort of a really important thing in investing. And what that basically means is that $1 today is worth more than $1 tomorrow. So whatever that other expression is, a bird in hand is worth, I don't know where the other two are, but same concept. That something today that you have is worth a lot more than something way out in the future. So something as a company that I'm going to make next year is worth more, not as much as money I have right now, but it's worth more than money I'm going to make 10 years in the future. So all of this needs to be discounted back. That is why we need this discount rate. Now, different people use different discount rates when they do this. And we can talk about some of the different considerations. And you as an individual investor may use a different discount rate that's more related to you and the returns that you want to get. But if you're doing this in a professional setting, you need to use one that's universally applied because our analysts don't know who's reading their research report. All sorts of different investors read it. So what they use, and what's generally used from a professional standpoint, is something called the weighted average cost of capital. So the WACC. Now remember, the cost of capital, if we go back to moats, cost of capital, we believe that most companies that don't have moats will eventually just earn that cost of capital going forward, because they want to be a going concern. They want to, and they can still be growing and everything else, but they are just earning that cost of capital. Great companies will earn more than that cost of capital. All right, so what is the weighted average cost of capital? The weighted average cost of capital is basically how much does it cost the company to go out there and source funds. And there's two different sources of funds, two main sources of funds as a company. You can go out to debt markets, so you can issue bonds, or you can go to equity markets and issue shares. So debt markets is pretty easy. That's an observable data point, because any company that's ever issued a bond, you can go out there and see what it's trading at, and that is their cost of debt. So if their bonds, no matter what interest rate they issued it at, we can do a whole session on fixed income, no matter what they issued it at, if it's trading at 3%, somebody sits there and tells you that like, oh, this bond is trading at 3%, that is their cost of debt. It means that they could reissue bonds right now at that same 3%, because that's how the market's valuing it. So we can go out and observe that. The cost of equity is a lot more complicated. Now, people do this in all sorts of different ways. They put a risk premium on a risk-free rate. So basically saying that government bonds, the risk-free rate, are trading at 4%. We think that there's an equity risk premium of 10% that we want to put on top of that. So we'll use 14%. People do it through this thing called the capital asset pricing model, like very complex. What our analysts do is they basically look at the overall risk of the company, and they have five different costs of equity that they include depending upon how risky the company is. But either way, you need to understand that the cost, the equity, is always going to be above the risk-free rate. There's always going to be a premium that people are going to pay for equities. So that's the weighted average cost of capital. That's what we're doing to discount back all these cash flows. All I've done here in this present value is I've gone out there 10 years in the future, and I've discounted, and the reason I split this up just so people can see it, you can see I've gone and I've discounted it by that weighted average cost of capital all the way back to the present day. So we want to know how much that company is worth today. And if I add all of these up, so basically what this says is, yeah, they're going to generate $324,000 in free cash flow. What is that worth to me today? $125,000, because I'm discounting it back. We add all of that up. So there we've got the first part, a little over $1 million here. Of course, a company will last, in theory, more than 10 years, right? Companies can last in perpetuity, as long as something doesn't happen. So we can't just value it 10 years. We need to put a terminal value on that. So whether you want to estimate out 5 years or you want to estimate out 20 years, you can do whatever you want, but you need to account for that terminal value. And what we often do, what analysts often do as a terminal value, is they assume at a certain point the company will start growing in a steady state. So in this case, what's the long-term growth rate? It's 2%. So I said revenue growth was going to grow at 8% a year. Now I'm saying it's going to grow at 2% after that 10 years, because frankly, I don't know, but I do need to value that. So what am I doing? I'm looking at that free cash flow in year 11. And then I am just mathematically calculating that terminal value. So all I'm doing is I am dividing the difference between the weighted average cost of capital and that long-term growth rate, or taking the long-term growth rate, subtracting it from the weighted average cost of capital, and dividing by that year 11 free cash flow. Then I discount it back to the current day. So mathematically, all I'm doing there, and the important thing is the concept, is I am calculating that terminal value. So now I've got a total value for a company. So that's great. Got the total value. I need to then make a couple adjustments. So first thing I need to do is I need to subtract the total debt, because remember, I'm a shareholder. There are also bondholders that have that do have a say on, or do have a claim to cash flows generated by the company. They get paid first. So I need to get rid of the debt. And that's the reason why I didn't take interest out, that interest expense, even though that's a real expense and that's a cash expense. I didn't take that out because I'm going to remove it here. So I subtracted the debt. I add back in the cash because that is something that I'm entitled to as an equity holder, right? Bond holders get paid off. I'm left with total value, and all I do is divide that by shares. So however many shares that are out there, I divide the total value of the company by the shares, and I stuck with $24.51. All right, so I did a couple things on here. Hopefully that made sense. Obviously ask questions. If it didn't, I'll save some time for questions. So I've calculated the total value per share. Now, what is very important about any one of these models, so because this is in Excel and because there's formulas, it looks like this is just purely math and science and how you do this. The very important thing and the problem and what makes investing more an art than anything else is that, yeah, this is a model. What's on here adds up, but it's the whole theory of garbage in, garbage out. So what matters are all the inputs that I put in here. And that is why investing is very, very difficult. So what are some of the big inputs? And what I did is I screwed around a little bit with these inputs on the same model and saw what it did to the change in the value of shares. So 1% reduction in the weighted average cost of capital. So I changed that. What happened? Company went up, the value went up by 18, close to 19%. Now, this is why when interest rates go down, equities are worth more. So I think I say this a lot. Hopefully it makes a little more sense now that if your discount rate is less, right? You are discounting something by less, it's worth more. It's less of a discount. So what we're discounting is cash flows into the future. The same exact cash flows. If interest rates go down, they will reduce the discount rate. Those cash flows will be worth more. The company will be worth more. That is why valuation levels rise when interest rates go down. So right here, just a 1% reduction in this model, all of a sudden that change goes up. Now, think about mathematically how this works. The higher those future cash flows are far out into the future, the more of an impact reducing the discount rate will have, because there's all these different years that you're basically compounding backwards on. That is why growth companies do really poorly when interest rates go up. So if you looked at some of the stuff that's happened in the market this year, so what happened in February and what sort of recently happened around inflation is that people got very worried that inflation was going up and that because of that, interest rates would go up. So what are the companies that got hit really hard? Growth companies. All the tech companies went down a lot more than other companies. So in rising interest rate environments, just think about how mathematically this works. When that discount rate is going up, it's going to impact the companies with cash flows far out into the future, all this growth baked into their cash, more than a value company that's growing slower, so that more of that value comes from years, a couple years out in the future, right? Because they're bigger cash flows now, but they're growing slower. So that's why interest rates going down are really beneficial for growth companies and going up aren't great for growth companies. The other thing, of course, is your revenue estimates. You are predicting the future, right? You're forecasting the future. Future is, of course, unknowable. So that's really important. So whatever you're estimating out there, that's important. Terminal growth rate, of course, that's important as well. If there are changes in the terminal growth rate, remember that's sort of out into perpetuity. So you can see the different changes that we've had, close to 8%, 10%. I did this around COVID, back when COVID was a thing, before it became a thing again. And I did this because people were very, very worried, obviously, what's going to happen when the economy shuts down. So what I was trying to demonstrate is that because of the way this discounted cash flow model happens, what happens if I just knock out all the cash flow in year one? I make that zero. So this is a company that makes no money for a year because there's restrictions in place. You can see that the change is actually very small. And sort of the point we were trying to make, that Morningstar was trying to make, and I was trying to make it, whatever, 100 of these ago when I first did this, is that if a company is strong enough to survive a period where they don't make any revenue, so they have to have enough cash, they can't be like Virgin, right? Can't go out of business, but if they have enough cash and they can survive, there really isn't a huge impact to the value of that company if there's just a pause on the earnings and free cash flow they make, as long as it comes back. So that's kind of the point I was trying to make with that. All right. So that is a DCF model. Let me show one more thing, and then we will do some questions. So ask questions. All right. So one thing I did want to talk about. So InvoCare, of course, runs a bunch of funeral parlors here in Australia. I wanted to just demonstrate some of the stuff we talked about, and I took quotes from Angus, who's our analyst. This is from the actual report. Okay, so let's talk about a couple of these things, just so you can use our analyst report to see what our analysts are thinking. And then whether you agree with them or not, it still can be a jumping off point. So he says, we estimate sales to grow at 8%, CAGRs, compounded annual growth rate, whatever. They're gonna grow 8% a year over the next 5 years. He talks about, hey, they're recovering from 2020. Why are they doing that? Why is revenue growing? They're going to raise prices. More people are going to die. All right, so that's good if you're in the funeral home. And yeah, they might gain a little market share. So think about that. Those are the different levers you can have, right? You can raise your prices as a company. You can sell more goods. In this case, more people die, so you get to sell more funerals. And you can gain market share against competitors. So the pie is growing, more people are dying, you're taking more of that pie from your competitors, and you're raising prices. So those are the drivers for revenue. So that's what Angus thinks is going to happen. Whether it does or doesn't, we'll find out. Then he talks about margins. So margins, how are we translating that top line growth into EBIT, right? Earnings before interest and taxes. So he thinks EBIT margins will be 20% by fiscal 2025 from lows of 12%. So what's happened with InvoCare is a couple different things. Obviously, number one, there's been issues with funerals because there's been restrictions in place around how many people can go to a funeral. So they've had some issues there. The other thing they were doing before COVID hit is they were investing a lot in their business. So he's saying what's happening is those temporary investments and spending that they're making has caused margins to come down, but he expects they're going to return. So this is good for us as investors. We want margins to grow. So these cost-cutting initiatives that cost money initially, hopefully will pay off in the future, and they'll be able to do things for cheaper. And then, of course, we got to discount all of this back. So what is he using? He's using a 7.2% weighted average cost of capital. That's that WACC that we're using to discount things back. So anyway, I just want to share a couple quotes because, you know, the point and the reason our analysts write these reports and the reason we believe in fundamental research and understanding companies is so that we can, of course, talk about our opinion, whether you agree with it or not. It gives you a jumping off point. It informs you as an investor because that's what they spend all day doing. All right, so let's get into some questions. All right, so the anonymous attendee. So the anonymous attendee says, when I buy fixed interest bonds, a dollar I spend today is worth less when it's returned to me when my bond matures. How can I best reinvest the coupons to balance this out? Okay, yeah, so let's talk a little bit about bonds. So the way that you value a bond, by the way, is the exact same way, basically, that you use a discounted cash flow. So if I'm valuing a bond, what am I worried about? I'm worried about my coupon payments. So in this case, I put out a big expenditure today, but what am I getting back? I'm getting a coupon payment every year for the life of that bond. They'll pay me $10 a year. Okay, I know what that cash flow is. And then I have the terminal value. In this case, is I get my money back, right? I get that face value, the principal back on my bond. So it's the same thing. And when interest rates change, we recalculate that yield to maturity. And that's why prices change. That's why when interest rates go down, bond prices go up, because those cash flows are worth more. It's literally the same thing. The math behind it is the same. So the anonymous attendee is talking about the problem, of course, is inflation, right? So he or she is saying that the issue is that literally that $100 they get back in 10 years is worth less because of inflation. So yeah, what you're concerned about, of course, is you're concerned about, are you earning a return that is beyond inflation? Now, how can you best reinvest the coupons to balance this out? Well, reinvestment risk is actually a risk that all bondholders have. Now, the reinvestment risk can happen that if I bought a bond 10 years ago when interest rates were higher, I'll make up a number, 10%. and I'm getting these coupons back, but interest rates have fallen to 2%, my reinvestment risk is I can't reinvest that at 10%. Because now it's 2%. You particularly have these with mortgage-backed securities because you get that principal payment back. And particularly when interest rates, this is going on a tangent, but when interest rates reduce, you get more prepayment risk because people refinance their mortgage and pay it off. So it is an issue. Now you're looking at it a little bit differently. Yeah, I think the big thing is understanding that in any sort of inflationary environment, fixed income's not going to do that well. So potentially there is an opportunity to reinvest in something that would do well from an inflation standpoint. And we talked about this the other day, my terrible presentation on inflation. We talked about, okay, how can you do that? Look at real assets. So whether you're looking at real estate infrastructure, et cetera. All right, sorry, we don't have that much time. Okay, so we've got so Mike is asking a question. So he says, this might be a basic question. I don't think so at all. Why use a WACC for calculating net present value? Essentially what we're doing. Isn't the present value of money determined by inflation, or is this something specific to company values? Can you explain further? And then he says something nice. He likes webinars. So thank you, Mike. Okay, so let's talk a little bit about inflation and how inflation goes into this model. So two different things happen with inflation. And we talked about this the other day. So number one, we're looking at those revenues. So as I invest in a company, in theory, what I'm getting is hopefully a company is able to raise prices over time. So that inflation, in terms of us being able to pass on as a company, passing on those price increases to customers, that will be built into that revenue model. So when you're doing this, you need to think about inflation. Same thing happens when you're trying to translate that top line to the bottom line. You need to account for inflation that's going to impact inputs into your company, the cost of the goods sold that your company has. So that can be wages. You have to pay people more over time. That could be raw materials that go in there, right? If you're making beer, you got to go out and buy grain and hops and everything else that goes in there. So you should account for all of that in terms of your model. So that's kind of the inflation part. But yes, money, because of inflation, money is worth more or less in the future if there is inflation. But at the same time, from this standpoint, we're accounting for all of that. So we should add that in. Okay, Mike's asking another really good question, and this I did not cover. So he says, how much can we rely on compounded annual growth rate? So basically the growth rate and EBIT forecasts, because markets can change. What discount should we apply to control risk? Really, really great question. All right, so that DCF model, and I should have mentioned this, that DCF model, of course, provides a sense of precision that just isn't true, right? Because it's relying on forecasts of the future, which of course are unknowable. We don't know what's going to happen to the company. We don't know what's going to happen in the economy. We don't know what's going to happen in the world. So the problem with models like that is it gives you the impression that that is a precise number. It of course isn't. So how do we account for that? We account for that with the margin of safety. So what the margin of safety tells me that if I go out there and calculate something, and this is from our good friend Ben Graham that we talked about before, if I go out there and I calculate that a company's worth $23.45, that doesn't mean that I should buy the company at $23.44, right? We need to assume that we're wrong. We're humans forecasting the future. It's literally impossible to do. So we account for imprecision in our forecast. We account for the unknown that's happening in the world with a margin of safety. So that means that I want to buy that company for even less. Now, the margin of safety that we use at Morningstar adjusts based on the risk of the company. So our analysts will look, and there's something called the uncertainty rating, where they will look and think about how risky is this company? Does the company have a lot of leverage? Is the company operating in an industry that is really volatile? Is there just a lot of inherent risk in what the company is doing? So they will categorize those as higher risk companies. You'll see that in the uncertainty rating, and that will translate into a star rating that we have, whereas it will take more of a discount to get to our cheapest stocks with their 5-star stocks. But the lesson for you guys is to take a margin of safety and think about how predictable those cash flows are. If you're Coca-Cola, chances are in the next couple years, yeah, they've got some issues with obesity and things like that. Chances are in the next couple years, the economy's good if the economy's bad. If there's COVID, if there's not COVID, chances are they're going to continue to sell soda. There are going to be obviously changes to that, but that cash flow is much more predictable than a really risky company that's selling something that's highly leveraged to the economy with lots of other factors that are influencing it. So think about that. So the margin of safety should be different for different companies. Okay, we've got a good question. Okay, so Ricky's asking, please explain the terminology. Companies trading at 15 or 20 times earnings. Okay, so this is a good one. So we talked about in the discounted cash flow model that we are forecasting out cash flows, discounting them back. People often talk about companies. A sort of shortcut to look at companies is a relative valuation technique. A relative valuation technique is something like the PE ratio, the price to earnings ratio. Most relative valuation techniques are looking at the past. Now, we don't care about the past as investors, but we still use these shortcuts. So basically, what a PE ratio is you're dividing the price by the earnings. So when somebody is saying, so if you have a PE ratio of 10, that means 10 times, you're paying $10 for every $1 of earnings. So when somebody says a company is trading at 15 times earnings, it means somebody is paying $15 for $1 of earnings at that company right now. Now, that's basically a PE ratio. The thing that's really important, so it's just terminology. They'll say 15 times, 20 times earnings. So somebody will sit there and make a comparison. They'll say CBA is trading at 10 times earnings and NAB is trading at 15 times earnings. That means CBA is cheap and NAB is expensive. So that's where they're always using that, because you have to compare them. That stuff, a PE ratio cannot stand on its own. It has to be compared to history or a similar company. The problem is that you need to understand about the company to understand why that's happening. So one reason in my example that NAB could be trading for more than CBA when we're looking at historical earnings is because everyone thinks NAB's going to grow more. That NAB's going to have all this great growth and CBA is not going to grow at all. So all those PE ratios and things like that need to be within the context of what investors think about the company. So hopefully that helped, Ricky. Okay, so I almost swore again. We do have a lot of questions. So sorry, we are out of time. If you have any questions, apologies, I should have left longer for this. If you have any questions, just please email me at mark.lamonica1@morningstar.com. I will answer your questions. If anyone wants that spreadsheet, I can send along that spreadsheet. I am really sorry that we didn't get through them all, but this ending is going better than last week so far. So anyway, I'll be back on Thursday. We're going to talk about retirement and sort of the risks and considerations about transitioning to retirement. But yeah, please send me the questions, and sorry we didn't get to them. So thank you guys for joining, and I'll be back in a couple of days.